took a bit of a different take on credit in this book, and just sort of again linking it back to what we're seeing in markets right now. Andrew Lowe, adaptive markets hypothesis. Markets are clearly adapting to a fairly rapid shift in global monetary policy and obviously contemporaneous inflation dynamics. And we've seen market participants flip from pursuing the duration premium to the credit premium, right? So we've seen OAS spreads. They haven't really budged. If anything, they've tightened, especially in high yield land since the beginning of the year, while investors have sort of been fleeing duration into credit. I've always been of the opinion, and my analysis sort of suggests that the credit premium is a bit of a myth, right? When I've regressed the credit premium on, for example, risk balanced portfolio of equities and appropriate duration treasuries over the long term, and then I look for an intercept for the credit, and I don't see one. So but I know there has been some recent research that suggests that in fact there is a credit premium independent of rates and equity risk. So maybe just talk for a second about why you kind of shifted your views on the credit premium in this book, and what is the role of credit maybe going forward?
Yeah. I do think that the very, very fair questions you have there. I do think that as a first order thing, credit premium is closely related to equity. So one would somehow think that premium doesn't have too much extra over equity premium. It could, like, there are some ideas that, like there's maybe some illiquidity premium. We'll probably talk about that later, and we don't think there's too much of liquidity premium in general, so that's not too important. But another one is that sort of there's a different type of non-linearity. Equities are sort of long options, and credits are short options. So that could give some advantages to credit. So I think there are some logical reasons. Empirically, I think it does depend on the data. Like some research my colleagues wrote, where they found that there is a role for credits. I mean, it was a longer study, and it was maybe from some earlier decades that had more of that story. And again, I think last decade, partly I'm more positive because basically last decade was better, and it sort of, the previous book ended when credit spreads were still exceptionally wide, and now they are in the narrow end. And I do think that it's always right to try to adjust your any inferences you make on average returns. You quickly lose. Were there now some sample specific valuation changes? Could we adjust for them and see somehow what people were really expecting and requiring more neutrally without that sort of surprise part? So I think that's a good thing to do. So I think I'm pretty open to debating whether credits add much extra beyond the equity premium angle there. But one thing which I sort of highlighted in the first book and again now is that there's this one weird result that we find, that the average realized return on credits over governments, even for investment grade bonds, is a fraction of the average spread. And so sort of like, where did it disappear? And in my first book I wrote that this is about 25% of the spread is realized. Now it has grown to something like 50% because we have had a nicer decade. I think that's it. But so the more interesting question is, so where did it go? What was the source of the leakage? And there are some different reasons, but the most important one is index investors' tendency, and so this is sort of index calculations, tendency to sell so-called fallen angels. So fallen angels are the bonds that are downgraded from BBBs to BB, so basically to below investment grade. And many institutions have a rule that you have to sell them now. And then they are sold in a few weeks at fire sale prices. And it's weird. It's not a big part of the market, but it's big enough effect that's taken something like 30 basis points or something of the overall index returns in the long run, and supposedly also in the last decade. So I guess I would say then that if anybody does sort of the reasonable thing and tries to commit to not selling the fallen angels, do the right thing here, and so basically maybe change some organizational rules there, then we'll have 30 basis points more, and I think there's going to be a little bit better case for saying that credits deserve their role in the portfolio.
Yeah, that's a really strong potential source of alpha for organizations. Absolutely. And I first learned about the fallen angels premium. I don't know if you read the book Missing Risk Premium by Eric Falkenstein.
Oh,
Yeah.
no, he's great.